Hello, hi everyone, and welcome to this webinar organized by Doxity in partnership with Syracuse University. My name is Carolina, nice to meet you all, and I'll be your host for today's event on behalf of Doxity. I see here that the first people are already starting to join in. We're gonna wait just a couple of minutes before starting to allow everyone to connect. And in the meantime, feel free to say hi in our chat here in Zoom and please tell us where you're from since we're very curious. Okay, first of all, I want to thank everyone for joining us and thank our panelists for being here with us today. As you can see here, I'm not alone. I want to introduce you all to Dr. Tom Barkley, Professor of Finance Practice at Syracuse University's Whitman School of Management. Welcome. Together with Tom, you'll learn key valuation methods, including discounted cash flow techniques such as the dividend discount model, free cash flow to the firm, and adjusted present value for leverage buyouts. And you'll also explore the flow to equity method and using multiples from comparable companies, understanding when and how to apply each. So we will learn a lot of things and also some specific information about finance techniques. So you'll have also the possibility to interact with our speaker and ask him questions. And talking about that, I like to remind you that after the presentation, we will have a Q&A session in which you'll be able to ask their questions to the panelists. So don't be shy and just type all of your questions in the Q&A section here on Zoom, and we'll go through them at the end of the webinar. Also, another important information for those of you interested in receiving a certificate of attendance by Doxity for this free masterclass, stay tuned because we will post a link to get the certificate at the end of the session. Okay, I see some people writing in the chat. Hello from Brazil. Hi, welcome, and welcome, of course, to all of you that are connecting right now. We are here with Dr. Tom Barkley. We're here with Syracuse University. And so without further ado, I can now leave the floor to Tom for the presentation, and we see you later and enjoy this webinar. Thank you.
Thank you so much, Carolina, for introducing me. My name is Tom Barkley, and this session is on valuation methods. Now, I hope that what I cover will be of interest to those in the audience. It's going to be a variety of valuation methods that mostly relate to discounted cash flow analysis. So I'm going to give a quick overview and as well as just a discussion of four DCF valuation methods, then some multiples analysis, and then I'll take questions at the end. So let me begin here with a brief agenda. By way of introduction, I will introduce myself in another slide, and then we'll talk about an overview of different categories of valuation methods. I'll briefly mention something called a three-statement model, which I'm not going to go into in this particular session, but I would encourage you, if you are really interested in learning more about valuation methods, this is a starting point to get you engaged in how you would build a model that involves DCF. So discounted cash flow analysis is going to be the primary the meat of this talk, and we'll talk about four methods: adjusted present value, free cash flow to the firm, or sometimes also known as WACC, weighted average cost of capital approach, the dividend discount model, and the flow to equity. Then we'll look at some multiples analysis and a brief conclusion at the end, followed by Q&A. So by way of introduction, just a brief background of who I am and where I come from. My graduate or my undergraduate education was in London at Imperial College, where I got a bachelor's degree in mathematics. I worked for a brief period after that at NatWest Bank, where I was a bank officer. I was working in multiple roles around the bank on a fast track program. But I found that branch banking, which is what I was doing, was really not what I was interested in. So I left branch banking and went to do a postgraduate certificate of education, a teacher training 1-year program at King's College London. And my first job after finishing that program was as a math teacher and coach at a place called Kingsway Academy in Nassau in the Bahamas. Beautiful country, the Bahamas. If you ever get a chance to go to the Caribbean, I would strongly encourage you to go to the Bahamas. I worked there for 5 years, but again decided that maybe it would be of benefit to actually get some business experience and to use my knowledge of mathematics in a financial context or in a business context. So before I did that, I went to Brazil, and I saw that there was somebody in the chat from Brazil. I was born and raised in Brazil, even though I don't have a Brazilian accent. And my father was someone who was in charge of a small publishing company. So I went and I ran that publishing company for about a year before coming to the United States to do my MBA. My MBA was at Thunderbird, the Global School of Global Management in Arizona, and very much appreciated it. It was one of the most diverse experiences that I ever had. At any given time, there were roughly 50 to 60 different nationalities represented in the MBA program. When I completed my MBA, I went to work for a big energy company that some of you may have heard of. It's a little bit older now, and it's now become history. But I went to work for Enron, the large energy trader, oil and natural gas trader based in Houston, Texas. And I worked for their research group, where my experience was really in helping to create derivative pricing models that were used in an Excel add-in for the traders. Unfortunately, as you know, Enron went bankrupt, and I was out of a job. And my decision then was, do I continue in the energy industry, or do I go back to school yet again and get a PhD, which is what I ended up doing, where I went to the University of Florida, got a PhD in finance, and when I finished that, I came to Syracuse University, and I've been here almost 18 years as a faculty member. So that's a quick overview. If you have any connections to any of those countries, Brazil, the Bahamas, the US, or England, I'd be happy to chat with you further about that later. So this session is going to be about valuation methods. And I first of all want to clarify that there are many different categories of valuation methods for companies. There's the asset approach, where you look at the assets that are in place and try to estimate what the replacement cost would be if you had to take every asset that the firm owns and replace it with a new version. Alternatively, there is the liquidation value, where if the company had to shut down, how much could you sell the assets for in market terms to figure out what the value of those assets actually are. What we in finance do most of the time is try to figure out the cash flows that are going to be generated from projects that a company has. And so we call this the income approach, or an approach to finding the intrinsic value or absolute value for the firm. And for the most part, we look at discounting future earnings or dividends or cash flows back to the present. There is another method called the residual income method, which looks at discounting the difference between expected earnings and the accounting return on equity. The third approach is a market approach, and here we are comparing our firm that we have or project with other companies. And so we use multiples to make these comparisons, or even comparing with previous transactions in mergers and acquisitions for the purposes of valuation. So in this talk, I'm going to focus on discounted dividend method, discounted cash flow method, and comparable companies method. As I said, let me just mention the three-statement model. For those of you who are accountants, this will be somewhat obvious. But for those who are perhaps newer to business or just trying to understand how the financial statements of the income statement, the balance sheet, and the statement of cash flows, how do they fit together? Generally, we can think of a balance sheet as a picture, a snapshot at a point in time. And so usually we would have a year zero balance sheet and a year one balance sheet. And between the beginning and the end of the year, or maybe the end of fiscal year 2024 and the end of fiscal year 2025, we're going to have more of a movie, right? We're going to take pictures of what happens along the way. And so the income statement for the fiscal year measures changes in owner's equity. So essentially the net income that is generated is either reinvested and added to retained earnings on the balance sheet for the end of the year, or dividends are paid out to shareholders. And the statement of cash flows for the fiscal year essentially shows how cash has been sourced and used during the year. So all three of these financial statements are closely linked to each other. And if you have any two of them, you can calculate the third. For the most part, we are often given an income statement and a balance sheet, and we derive the statement of cash flows from that information. Now, in what we're going to see in the examples that we're going to look at, I will have a sample income statement and a sample balance sheet, and then we won't derive the statement of cash flows, but instead what we'll do is we will calculate free cash flows and earnings and dividends from those first two statements. So let's jump into the meat of this presentation, which is discounted cash flow analysis. By way of introduction, just some general points. Most DCF models in finance assume an anchor of 0 and discount all future cash flows back to the present. What I mean by that is that we ignore any value that the firm has currently, and what we do is we forecast income that is going to be generated in the future, find its present value, and we take that to represent the value of the firm in today's terms. There are different types of models, DCF models. Some calculate the value of the enterprise, such as the adjusted present value or APV model, and also the free cash flow to the firm or FCFF model. Other models go directly to finding the value of the equity that is made available to the shareholders. And so two methods here would be the dividend discount model and the flow to equity method. I should stress that these four discounted cash flow approaches are not the only ones, and I've seen lists of as many as 10 or 15 or 20 different DCF approaches, many of which give, depending on who's constructed or created the presentation, they give different answers. Part of this presentation, the purpose is to show you that under special conditions, the values of all of these discounting cash flow models should give you the same answer. Now, I do want to also mention that in accounting, so some of you perhaps have interests in both finance and accounting, but in accounting, oftentimes the anchor is assumed to be something other than zero, such as the book value of equity or invested capital. And what this means is that instead of assuming that the firm or a project has zero value today, we look at what the book value of the assets or the book value of equity is today, and we calculate changes in the equity or changes in the asset going forward. And so then we discount those changes back to the present. And one example of this is called the residual income model. Now, I should mention that all of these discounted cash flow models are very relevant for the CFA Institute exams. And as a CFA charter holder, I would be remiss if I didn't just put in a gentle plug to say that in addition to getting a Master's of Finance, you might also want to consider getting your Chartered Financial Analyst charter from the CFA Institute. So these particular topics are in the level 2 exams if you happen to be studying for this particular designation. Now, I'm going to provide an example here, and I was just talking to Carolina before the presentation began. For those who are attending today, I plan to send, or Carolina will send out a copy of the presentation slides, but also a very simplified spreadsheet that will have these calculations built into it. And so you will be able to then go in and see the formulas that are used for these calculations. And hopefully that will be of some use to you. So here's an example. A firm is valued over a period of 2 years, during which time earnings before interest and taxes, or EBIT, depreciation, capital expenditure, and increases in working capital are all changing. So the firm's capital structure changes significantly through changes in the level of debt. So we're going to make some assumptions. We're going to make assumptions about the risk-free rate, the market risk premium. So those two things allow us to use the capital asset pricing model to find our asset beta, our debt, or to find our unlevered cost of equity and the cost of debt. So if we know an asset beta and a debt beta, which I'm assuming here to be constant over the 2 periods, then we can calculate an unlevered cost of equity and a cost of debt using CAPM. In terms of growth rates, we're going to see that growth rates can actually be variable. We can have different growth rates for different line items on the income statement and the balance sheet. So you'll see that for income statement items like sales growth rate and cost of goods and SG&A and depreciation growth rate, those growth rates vary both in year 1 and in year 2. We also have differences in growth rates for current assets and current liabilities and CapEx in year 1. But in year 2, notice that the balance sheet growth rates are all the same. They're all set to be equal to the sales growth rate in year 2. So we can think of this as just being a long-term growth rate. When we use those assumptions, here I have an income statement with our starting values in year 0, and then we modify those using the growth rates to get our year 1 and year 2 cash flows. In particular, I want to point out that the dividends that are paid out, so strictly speaking, the last 2 lines here, dividends and retained earnings, are not lines that are officially part of an income statement, but I'm including them here because they form a part of our calculations that we will see later on. So the dividends in year 1 are 41,000, in year 2 almost 60,000, and we'll see those numbers crop up again. Similarly, a simplified balance sheet, and so with the balance sheet, we have current assets and then fixed assets, net property, plant, and equipment. We have current liabilities, long-term debt, and owner's equity. and the balance sheet balances, the total assets equal the total liabilities and equity. What I will highlight here is the long-term debt, the $230,000 that we see in year 0. And so this number is a number that, again, we will see crop up when we come to later calculations. So at this point, I'm going to transition into talking about 4 different DCF methods. And for each of these, I'll try to be brief. There are 3 slides for each one. I've tried to keep formulas fairly simple. At least I think they're simple. Hopefully you will too. When we think about the adjusted present value, or APV model, we can think of this as being in 2 parts. The value of the levered firm, VL, is equal to the value of an unlevered firm, an all-equity company, plus the value of interest tax shields. All right, so if we were to take all of the interest tax shield benefits that we get each year from now until forever and discount those interest tax shield benefits back to the present, then we can find the present value of those interest tax shields. So I'm dividing both of these valuations into 2 separate parts, and each one is going to involve a cash flow and a terminal value. So for the value of the unlevered firm, we have the free cash flow to the firm in year 1, plus the terminal value of all future free cash flows. So free cash flow in year 2 divided by the unlevered cost of equity, or RA, the return on the assets, minus the growth rate. So TVU1 is actually the free cash flow in year 2. And similarly, TVITS1, the terminal value of interest tax shields in period 1 is going to be the interest tax shields in year 2 divided by RA minus G. Formulas for free cash flow. This is a standard formulation that you will see in most corporate finance textbooks, that the free cash flow is EBIT times 1 minus the tax rate. We add back that year's depreciation. We subtract off capital expenditures that the firm might have, and we also subtract off changes in net working capital. So you can think of it as our net operating profit after taxes minus investments that have to be made into maintaining the firm over time. And our interest tax shield is just our interest expense, which is our cost of debt, RD, times the previous year's level of debt, and then times the tax rate. So those represent the cash flows in this model. And this slide shows how we would calculate all of those values from the balance sheet and income statement. So to calculate our free cash flow, we're calculating our earnings before interest and after taxes, EBIAT, adding their depreciation expense, subtracting off our capital expenditures, and subtracting off increases in net working capital. That will give us our free cash flow for year 1 and year 2. We can then find the terminal value in year 1 for all the cash flows that go beyond that, and then we'll discount at the unlevered cost of equity. We can find the present value. The present value is $575,210, and that would represent our year 0 present value for the unlevered firm. But in addition to that, we have to do the same for our interest tax shields. We're going to take the interest tax shields in year 1 and year 2, calculate the terminal value in year 1 for all future interest tax shields, discount at the unlevered cost of equity in order to get a present value of $67,831. And then finally, the value of our firm, our enterprise value, is going to be the sum of those two, which is $643,040. So this first approach, this adjusted present value approach, it has certain uses, right? When would we use an APV model? This is most suitable when evaluating a company or a project with a significantly changing capital structure, especially where we have levels of debt that are known in advance, such as with a leveraged buyout, with an LBO, usually an acquirer, the firm making the acquisition, is going to have high levels of debt, but we know in advance how that debt is going to be paid off over time. And so if we know the levels, then the APV method is very helpful in allowing us to determine what the cash flows are going to be in each of the future periods. So our financing strategy has a big impact on the overall value due to these interest tax shields that are involved. The model is also useful when we're analyzing complex financing arrangements or ones that have debt levels that change over time. And so I'll just point out that with the APV model, it is most suitable for instances where we have known dollar values of debt. Let me transition to looking at the free cash flow to the firm model. And so here, and all of our other sets of equations are going to be a little bit simpler. They're going to be like this one. Here we have our free cash flow to the firm in year one, plus our terminal value in year one. But this time, we're not discounting by the unlevered cost of equity. We're discounting by our weighted average cost of capital in year one. And so we can calculate our terminal value in year one using a slightly different weighted average cost of capital for year two. So here the WACC can vary over time. And the formula for the weighted average cost of capital is basically an after-tax cost of debt that is multiplied by the debt ratio plus the cost of levered equity multiplied by the equity ratio. And the free cash flow to the firm, that stays the same as what we had before. So when we use this formulation, we end up seeing that the free cash flow, that hasn't changed, but now our terminal value is different because we're using a different discount rate, right? We have calculations for our percentage of debt, our after-tax cost of debt, our percentage of equity, and our cost of equity. And so our weighted average cost of capital for year one and year two, it's a different discount rate than what we had for our adjusted present value model. But despite all of these differences, we end up with identically the same firm value. So the big takeaway that I want to point out already at this stage is that we can have different methods, different discounted cash flow methods, and still get the same results. And I mention this because most corporate finance textbooks will present one method using an example, and then they'll present a different method using a different example, and perhaps intentionally never try to show that the two will give you identical results. Okay. So when is this model useful? It's most suitable when we're trying to value a company that has a significant amount of debt or a changing capital structure, because it provides a more accurate picture of the overall cash generation potential that a firm actually has, regardless of its financing choices. And so it makes it ideal for comparing companies that have different leverage levels. One of the things that we do prefer with this particular method is that the debt to equity ratio stay constant. So even though debt levels are changing, one of our key assumptions in this method is to look at the debt to equity or debt to value ratio and make an assumption that that is constant. Now, it doesn't have to be. In fact, these Excel spreadsheet models that I'm showing you, the debt to equity and the debt to value ratio do change from one period to the next. So I'll come back to that point towards the very end of the note. Okay, so we've talked about two methods so far, the APV and FCFF methods. Both of them find the enterprise value of a company. They find the whole value of the firm, debt plus equity. But the next two methods, the dividend discount model and the flow to equity method, they find only the equity value of the firm. So in this case, the equation for the company's equity using a dividend discount model is just the dividend next period plus the terminal value, and then discounted at the levered cost of equity. And so here we have that our terminal value in year one is the dividend in year two, divided by the levered cost of equity in year two minus the growth rate. So this is a growing perpetuity. And our cost of equity in each period is given in terms of our unlevered cost of equity, or our business cost, our RA, plus the debt to equity ratio times RA minus RD. So we can plug in our dividends. These dividends are the ones that were on that income statement slide that we saw earlier. We can find the terminal value in year one, add those two numbers together, the dividends plus terminal value, and then discount at the unlevered cost of equity of 17.3%, and we get $413,040, which works out to be exactly the same as the $643,000 enterprise value minus the debt that we have in year zero. So once again, we get the same valuation, even though our formulas are quite different. So when do we use a dividend discount model? Typically, if a company is a mature company that has a consistent history of paying regular dividends, and we can forecast with some certainty what the dividend growth rate is going to be in the future, then we can find the present value of all those future dividend payments to calculate the stock's intrinsic value. On the flip side, this model, the DDM model, is not suitable if you have a startup company that doesn't pay dividends or doesn't have share buybacks, repurchases along the way. So if a firm has not established itself yet in terms of paying dividends, or a firm that has very volatile dividend policy. 1 year it pays $0, the next year it pays $5, the next year it pays 50 cents, and then $3. If it's very volatile and there isn't any consistent growth, then it's hard to use this model for those types of firms. The last of our DCF methods, and we're coming to a conclusion here on the DCF methods. I hope I haven't bored you with too many formulas and spreadsheet values, but like I said, it's easier to see when you actually get the spreadsheet in front of you. So this last one is called the free cash flow to equity, or flow to equity method. And so what we're doing to find the company's equity value is the free cash flow to equity in year one plus the terminal value in year one, where again, our terminal value is just the free cash flow to equity in year two, divided by the levered cost of equity in year two minus the growth rate. Our levered cost of equity is the same formula as we had for our dividend discount model, but this time the free cash flow to equity has some modifications compared to the free cash flow to the firm. First of all, you'll notice that we subtract out our interest expense. So we have our earnings before interest and taxes minus RD times DT minus 1, which is our interest expense. So we've now calculated our earnings before taxes, and we multiply by 1 minus the tax rate to get our net income. We add back depreciation, subtract off our capital expenditures and changes in net working capital. But then we also have to add changes in debt. So if a company borrows more money, it's going to have more cash. And in theory, then, it has more free cash available to give to shareholders. So we have to include this last term at the end. So once again, just showing you some values. These values are tied to the income statement and balance sheet. You'll notice down here that we have our free cash flow to equity. Turns out in this example that the free cash flow to equity exactly matches the dividend payments that go to the shareholders. And so when we discount our present value of the free cash flow to equity in year one, plus the terminal value, we use our cost of equity as our discount rate, and we get our equity value as, again, $413,040, which is the same as the enterprise value minus debt. So the big takeaway, I guess I'll just mention, when do we use this model? The flow to equity model is suitable when we're looking at a company's intrinsic value, and you really want to focus on the cash flows that are available to the equity holders and no one else, especially in situations where the company has a stable capital structure with a consistent debt to equity ratio. So just like the free cash flow to the firm approach, the free cash flow to equity again assumes or aspires to having a constant debt to equity ratio. So this model is useful when the company's financing strategy is not expected to deviate too much from where it has been in the past as we look forward into the future. So some key principles to take away from these models. In each of the models, we've found the horizon value or terminal value, and we calculated that first by assuming that all future cash flows beyond the horizon are essentially a growing perpetuity, that each year they grow at a constant rate, the free cash flows grow at a constant rate off to infinity. I'll just point out that you don't have to use a growing perpetuity if you know of a stable multiple, such as a price to earnings multiple, and you can find the value in your horizon year. So our horizon year is just year one, but most of these models are built out to have 5 or 10 or years into the future. If you know an appropriate multiple for your horizon year, you can find the value of the firm in that horizon year, and you could use that instead. So the cash flow that occurs in the horizon year is then added to the terminal value, and that will give you the value of the firm in that horizon year. And then we recursively repeat this process going backwards until you get a value in year 0. And that allows us to find the present value of all of the future cash flows or dividends that are going to occur. So I want to spend just the last few minutes talking about multiples. Everything I've said so far about discounted cash flow valuation tries to calculate an intrinsic value of a firm based solely on information we have about that company. But in industries that are growing or changing very rapidly, oftentimes we care a little bit less about intrinsic value and a little bit more about the valuation of our company relative to its peers. So a multiples analysis is a relative valuation. In some situations like this, intrinsic values are not needed, and instead we want to see what does our company look like compared to our closest competitor. So the most commonly used multiples, I've listed 4 here, but you could easily find a list of 15 or 20. The price to earnings ratio or PE ratio, the EV to EBITDA. You can understand why we use that acronym is because it represents enterprise value to earnings before interest, taxes, depreciation, and amortization ratio. And that's quite a mouthful. So EV to EBITDA, much easier to state. Market to book value of equity is a term that's often used in academic circles. In practitioner circles, it's referred more to as the price to book ratio. And finally, sometimes when we're not looking at equity values, but we want another metric, we might look at price to sales ratio. Now, these relative valuation metrics are quite helpful when you have situations where perhaps you're trying to value a privately held company. So you don't have knowledge about its income statement or balance sheet. But if it's in the same industry as a publicly traded firm, then you can compare things that you might know, like earnings or EBITDA or sales, with the earnings or EBITDA or sales of the publicly traded firm. And if they are relatively similar, you can then apply that multiple to find what value the privately held firm should have. So as a rule of thumb, in mergers and acquisitions, oftentimes target companies, privately held target companies in the middle market sector, a kind of underlying average for enterprise value to EBITDA ratio would be about 5. And depending on the industry and also depending on peculiarities for the company, that 5 might be higher or lower. So here are some calculations for these multiples, these values for the forward-looking price to earnings ratio, EV to EBITDA, price to book, and price to sales ratio. One point that I'll make here is that you see that the metrics are actually quite different from each other. So you would really need to compare these multiples with other firms in the industry and look across the same multiple for many different firms to figure out perhaps what the average multiple is for the industry. When do we use multiples? Like I said, these are most suitable when we're comparing a company to its industry peers, especially when you need just a quick back of the envelope assessment of the company's value. And it might be hard to go through all of the assumptions related to the specific details that would go into a DCF model. If it's a stable industry and all the firms have similar business models and growth characteristics, then multiples are a good way to go. So these standards allow for a straightforward comparison using PE multiples or EV to EBITDA. We're very close to my allotted time here, so I'm going to just wrap up. I'm going to conclude with a summary and then a mention of some more advanced techniques. So what we've seen so far is several DCF valuation approaches that are typically used to find an absolute valuation or an intrinsic value for a firm, and several multiples that are used to find relative valuations. So valuation in general, in broader terms, is both an art and a science. It's very tempting. So like I mentioned before, I have a background, I have a degree in mathematics, and so I love formulas and I love numbers. And it's very tempting to think that, well, if I want to value a firm, all I have to do is pick a whole bunch of numbers, plug them into a model. It's going to tell me the precise value of that company. In actual fact, the story behind where you get the numbers is perhaps far more important than the individual numbers themselves. So calculating cash flows is important, but the input assumptions that underlie growth in sales, profitability margins, distribution policy, capital structure, leverage. I could talk about management, corporate governance, economic conditions. All of these things are going to affect your value for your firm. So remember GIGO, garbage in, garbage out for any model, right? You could have the best constructed model, but if your assumptions are incorrect, you're going to get valuations that are also incorrect. So often a back of the envelope estimate from a multiple might be more accurate than a detailed DCF model. Last slide, more advanced techniques. Even though we haven't discussed it in this session, real options analysis is another method used to value companies and projects. So the real options techniques, the techniques associated with financial options are applied to situations where you have an economic environment and market conditions that relate to a particular project or firm, where those conditions are highly volatile, but at the same time allow flexibility for management. So good examples might be oil and gas exploration or pharmaceutical R&D, right? You don't know what the outcome is going to be for the research that you're doing, and there's the potential for having huge success. There's also the potential that your research just gets thrown in the garbage. And so using the concepts of volatility of assets, we can build real options analysis models. So typically the firm, the company that uses this type of analysis will have the choice to either continue with their project, even expand, grow the project beyond what its normal or initial dimensions were intended to be, or abandon, close down, shut down the project, depending on future outcomes. So thank you so much for listening. We're right at 45 minutes past the hour, 46 minutes. I'm a minute past due. And so I'm going to allow Carolina to give me some of these questions, some of this feedback, and I'll try to answer as many questions as I can.
So hello again, and of course, thank you, Tom, for the really interesting presentation. Actually, I see a lot of curiosity both in the chat and in the Q&A box here. So I'm going to read you some questions that we have. So the first one is, it's a basic one. What is the terminal value?
Yes, great question. Perhaps I should have been clearer when I was talking about terminal value. Supposing we are trying to evaluate a company or a project, and we have cash flows that are expected to go on forever, right? We know that in the real world, things happen to companies, and even 100-year-old companies, all of a sudden, they face a downturn in the economy, or there's a new technology, and they go out of business, right? So 100-year-old companies can collapse, can go out of business, just like 6-month-old companies. But we assume that if a big company is stable and it has good growth prospects, that it will continue in business forever, right? Well, it's hard to model forever in an Excel spreadsheet, or even to think about, how many cash flows is that? So typically we would choose a horizon. We would say, well, let's build a model that goes out 5 years. And at the end of the 5th year, we're going to use some assumptions to estimate what is the value of all the future cash flows beyond year 5, and put that valuation at year 5. And we call that our terminal value or horizon value. And so once we know our terminal value or horizon value, it's our estimate of what the firm should be worth 5 years from now. But we have intermediate cash flows. We have cash flows that we've forecast we will receive between now and year 5. So we need to discount back to today not only the terminal value, but each of the intermediate cash flows that we expect to receive. So I hope that answers that one.
Sure, thank you. And another question from another student is, does this intrinsic valuation coincide with the market valuation of the companies in the long or short term? What is the difference between them?
Another excellent question, right? So I should point out that if you go into the business of valuation, if you work for an investment bank, or perhaps a hedge fund, perhaps a private equity firm, and it's your job to estimate the value of a firm. Typically, you're not going to use one method only. You're probably going to do a discounted cash flow analysis using one of the models that we talked about, and 2 or 3 or 5 different multiples models, and perhaps average these various results that you get to kind of give you a picture of what the firm is truly worth. And I would venture to say that if the discounted cash flow valuation is very different from all of your multiples models, then maybe you should rethink some of your assumptions. But there are times when there are differences that result, and that could be because the industry as a whole is growing faster than other industries. And so perhaps all of the valuations, all of the companies in that industry are overvalued. So their intrinsic values that you might calculate would be below their market values that you observe on a website like Yahoo Finance or Google Finance or the Wall Street Journal. Why do I say this? Market conditions can have an effect on the valuation of individual companies. People's perceptions can have an effect on the valuation of individual companies. So although the examples that I've shown you are all consistent with each other, it doesn't mean that we observe that in the real world. Sometimes firms in a particular industry, their valuations are higher than expected. Sometimes their valuations relative to their peers are lower than expected. So that's why I say we need to use a combination of these approaches to get there. So I know that that was perhaps saying in response to the question that was asked, it depends, right? They're not necessarily going to all match in the short term or even the long term, but in theory, they should match in the long term.
Thank you so much. So another question here is, I'm curious about handling changing debt schedules. Do we need to recalculate the discount rate for the tax shields every time the company's leverage shifts?
So that's a great question. There are, again, different academic perspectives on how you would discount your interest tax shields. In particular, the concern would be whether the tax shields have the same risk as the debt that is associated with those tax shields, or whether the tax shields have the same risk as the business in general, right? Do tax shields change because of what the business is doing? And so in the examples that I showed here, I've opted to show you or to illustrate with interest tax shields that change according to how the business changes, all right? So debt would be rebalanced from year to year. And when we do that, when we make that assumption, then all of these different models actually are consistent in terms of their final valuations. When we look at interest tax shields and discount at the cost of debt, then we probably would need to make changes every period to take into account the changes in cost of debt or the required return on equity.
Is there one of these methods that is preferred?
That's a great question. I've tried to show as we went through the DCF approaches that different methods are suitable in different circumstances, right? So a dividend discount model is great if a company actually pays dividends. If a company doesn't pay dividends, then it's very hard to use a dividend discount model to find the valuation for that firm. And in that situation, you might want to use the free cash flow to the firm or the flow to equity methods. For leveraged buyouts, as I mentioned as we were going through, the APV approach is probably the best one, because rather than assuming that debt to equity ratios stay constant, the concern is about the level of debt and we can then calculate interest tax shields based on the level of debt. And so that level of debt is going to decrease over time, and we can then calculate how much the interest tax shield should be for each period.
And I see another one that is, how do you suggest incorporating potential bankruptcy or financial distress costs into an APV analysis, especially when the project's debt load is significant?
That is, I love it when I get all these really excellent questions. Okay, so thank you very much to the questioners. I'll point out that with how we adjust for bankruptcy, our estimate of bankruptcy should always be an adjustment in the numerator. We should make adjustments for our expected cash flows. A principle is you never adjust the denominator. You make the assumption that the denominator, the discount rate, is still going to be the same, but the cash flows, the expected cash flows, might be less, they might be reduced if you anticipate that there is some probability of default or financial distress or bankruptcy. So you'd have to build into your model, what is your expectation of default for each of the different sets of cash flows. When there's high leverage, lots of debt, then maybe the possibility of default is higher. And so our expected cash flow in the first few years might be lower than anticipated. But as we go further out into the future and our LBO matures and we pay off a lot of that debt, then down the road, perhaps our expected cash flows are much closer to the ones that we had originally estimated without incorporating the bankruptcy.
So the last two questions I see are, what is interest tax shield?
Yes, perhaps I should have explained this a little bit better when I was going through. Because corporations are taxed on their earnings after they have to pay interest, right? So for example, if a firm has borrowed money and it has to pay interest on the money that it's borrowed, then that interest expense is deducted before the government requires the firm to pay taxes. So as you can imagine, if you borrow lots of money, it means you're going to have lots of debt and lots of interest expense. And as a result of that, you're going to pay less in taxes. So the idea of interest tax shield is that when the interest expense is higher, then you actually have a reduction in the amount of taxes that you pay. And this adds value to the firm. And it goes back to a couple of Nobel Prize winners, Miller and Modigliani, in the 1950s and 60s, who developed the idea that under certain circumstances, their basic model assumptions were that under certain circumstances, capital structure, in other words, debt to equity ratio, was irrelevant. It didn't matter for the value of the firm. One of those assumptions was that there were no taxes in the economy. But as soon as taxes were introduced, then they realized that there was a benefit for a firm issuing debt because they essentially got to operate at higher levels. They had more capital to work with. And as a consequence of that, then the value of the firm was higher than if it had just remained as an unlevered firm or a firm with no debt. So interest tax shields represent that additional value, that additional benefit that is obtained when a firm issues debt as opposed to not issuing any debt.
So last but not least, we have, How might the APV framework be adapted to incorporate additional benefits or costs, such as subsidies, grants, or unique financing structures in a project valuation?
Sure, I'm glad that you asked that question. In my formulation here, the APV method has had some simplifying assumptions where all I assumed is that there is an increase in value due to having debt in the capital structure. But in reality, the APV method adjusted present value would adjust for all kinds of other things. So if there are growth opportunities, we could add a real options analysis. If there are financial distress costs, as some people have mentioned, we could subtract the cost associated with the financial distress or the default probability. If there are marketing opportunities or specialized financing arrangements or grants, as the questioner asked, these could be added on to our basic, what's the value of the unlevered firm? Unlevered firm meaning no debt, right? So if you have a firm with no debt, it's all equity, only shareholders, then these other both benefits and costs can be added on as separate chunks into our valuation calculation. So thank you for that last question. I think that's a good place to finish. And Carolina, before you wrap up, I'll just mention that as a professor here at the Whitman School of Management, if you do want to get in touch with the Whitman School at Syracuse University, then there is a link that can take you directly there, whitman.syr.edu/ms. And if you actually want more information than what you can find on the website, or you can't locate something on the website, you can send an email to busgrad or businessgrad, it's BUSGRAD @syr.edu, and just reference in your title of the email that it's related to the Doc City Masterclass session that you attended.
Exactly.
Okay.
Perfect. Yeah, just also write this information in the chat. So if you want to, you can just copy and paste the website or the email contact. As also Tom mentioned before, you can schedule one-to-one meetings. So if you want to receive more information, you just have to contact them, of course. And also, I would like to remind you that in the next couple of days, you will receive an email with the contact details of the Syracuse University, and also the recording of this webinar. So if you have lost something, or if there's something that you want to see again, to take some more information, don't worry, because you will receive the recording on YouTube. And also, I've just shared also in the chat the link for the certificate of attendance. So if you want, you can click and receive it. And of course, I want to thank you, the panelist, Tom, for being with us today, for the really, really interesting presentation, and for the availability and kindness. Thank you so much. And also to all the students and the participants that are being with us today, for the curiosity, for all the questions. Thank you so much. Of course, we hope to see you again in the next webinar organized by Doc City in partnership with Syracuse, to receive some more information and more insights about this beautiful university. So thank you so much, and have a really, really nice rest of the day.
Thank you.
Thank you. Bye-bye.